Okay, here's a weird paradox for you. SAP posts double-digit profit growth, cloud revenue is surging, but their CFO basically admits their operating margins only look this good because the stock crashed 28%. I mean, welcome to Earnings Unscripted. It is April 23rd, 2026. We are looking at SAP's first quarter today.
Yeah, the good old SaaS apocalypse bailout. It is amazing what a tumbling share price does for your cash-settled stock compensation liabilities. But look, the top-line numbers look perfectly fine. Total revenue hit 9.55 billion euros, up 6% year over year. Operating profit was 2.87 billion, jumping 17%. EPS came in at €1.65. But yeah, you scratched just 1 millimeter below the paint, and they needed that market drop to hide some very real friction.
Exactly. And we love finding the friction. Real quick, though, before we dig into the footnotes, a reminder that nothing we say here is financial advice. We are just two friends trying to decode why a global ERP giant is relying on market panics to hit margin targets. So please do your own research. But okay, speaking of the panic, the stock behavior this quarter was just a roller coaster, right?
Total bipolar tape. Over the quarter, the stock just bled out. It dropped about 30% since the January highs. Entering earnings, it closed regular hours around 163. Then the numbers drop, and after hours, the algos completely lose their minds. Spiked up to 181, chopped around violently, and then just exhausted itself. By the time the call started, it was essentially flat compared to the previous day.
So all that noise just to end up exactly where they started. Though, looking at the segments, it was not all noise. ERP seems to be doing the heavy lifting. Cloud revenue was up 19% to nearly 6 billion euros. And I think they're finally proving their AI story is actually working in the real world, like that truck manufacturer anecdote.
Right, Daimler Trucks. They plugged SAP's AI into their supply chain network, and it supposedly optimized their quoting enough to generate 70 million euros in extra profit in a single year.
That is just massive.
It is. It validates the idea that SAP's proprietary data is an actual moat. But I think that anecdote is doing a lot of PR work to distract from the macro reality dragging on the rest of the business.
Right, because geopolitics are finally biting. Christian Klein admitted the conflict in the Middle East basically froze deals in March. Customers were just too busy firefighting physical supply chains to care about software upgrades.
Which shatters the illusion that enterprise software is totally insulated from regional conflicts. The pipeline slipped. And the real tell, the part that actually worries me, is how management is covering it. The CFO flat out confessed they're relying on the newly announced Reltio acquisition to protect their 2026 cloud revenue guidance.
Wow. Okay, so buying your way to the guidance line, that's a pretty massive flag. I think we need to look closer at that and break down exactly how much of this quarter was organic execution versus just convenient accounting. Let's get into the details.
Yeah, because if you look closer, the accounting is doing a lot of heavy lifting. Take their free cash flow, for example. They reported 3.2 billion euros for Q1, which sounds solid until you read the fine print on how they actually define free cash flow now.
Oh, right, the footnote. I saw they tweet the methodology, but I didn't quite process what it meant.
Well, starting this cycle, they completely redefined the metric. They now include proceeds from selling property and intangible assets, but they exclude interest paid. It is a neat little trick to make the historical operating trend look just a bit friendlier.
That feels why tweak a core metric right now, especially since they just had that massive cash sink this quarter?
You mean the Teradata settlement?
Right, exactly.
Yeah, they cut a 408 million euro cash check just to finally close a lawsuit from 2018. That is a heavy drag on cash, so redefining FCF gives them a bit of optical padding.
Optical padding. That is a very polite way to say financial engineering.
I am trying to be generous today. But look, if you want to talk about padding margins, we really should look at how they're running the actual business. This whole Customer Zero initiative.
Oh, is that where they test the new AI tools on their own employees first?
Employees, yeah, and on their customers. They're pushing for 2 billion euros in run rate efficiencies by 2028. And Christian Klein was very explicit on the call. This is a quote. He said, AI assists 100% of support cases, and 20% of our tickets are even resolved by AI, fully autonomous.
Wow. Geez. 20% fully autonomous. Zero human touch.
Zero. Which is obviously fantastic for the gross margin on services.
Sure, but if I'm a legacy customer paying a massive premium for enterprise support and my problem gets routed to an AI agent, how does that not hit customer satisfaction? Because I actually looked for their net promoter score in the filings this time, and it was just gone.
Gone because they killed it.
They just dropped NPS entirely, the standard benchmark for software?
Completely. Welcome to the KPI graveyard. They replaced it with a proprietary metric called Cloud CSAT, Cloud Customer Satisfaction.
Oh, come on. Why do they do this?
Because it resets the baseline. Think about it. NPS was dragging them down because legacy on-premise customers are miserable about being forced into cloud migrations. By switching to Cloud CSAT, they're only measuring the sentiment of customers who already bought into the cloud transition. It strips out all the anger from the legacy base.
That is actually brilliant from a survival standpoint. Terrible for transparency, sure,
Yeah.
but you just change the test so you can't fail.
It's entropy with better marketing. You isolate the variable that looks good and just ignore the rest. So you pair that new KPI with the cash flow definition tweak, plus the stock-based compensation relief we mentioned earlier. It's just a highly curated quarter.
Which really forces you to step back. If the organic momentum is cooling enough that they need to curate the optics this carefully, where does that actually leave them heading into next quarter?
It leaves them buying a bridge to their targets. Literally. Management maintained their 2026 outlook, but they kind of gave the game away. The CFO, Dominic Assam, actually admitted they need to include the new Reltio acquisition, which is completely non-organic. He explicitly said they needed it to, quote, protect the range.
Protect the range. That is just a polite way of saying your organic growth couldn't actually cross the finish line.
Exactly. They need Reltio's $185 million in annual revenue to paper over the deals that just stalled out. Because look, the geopolitical conflict in the Middle East actually broke their closing timelines. Supply chains get threatened, and suddenly an ERP upgrade is not the immediate priority. So they expect cloud growth to slightly decelerate going into Q2.
Which makes sense, right? I mean, you can't exactly forecast a regional conflict, but stepping back for a second, if you ignore the M&A band-aids, do you think their core argument holds up, like against the hyperscalers and the pure AI vendors?
Honestly, yeah. I think they have a massive structural moat. Sure, the pure AI guys build incredible language models, but Christian Klein made a very valid point. He said SAP has 50 years of business logic trapped in those systems. A generic AI model does not naturally know how to securely correlate a company's HR data with its supply chain logistics, but SAP does.
So essentially, an external AI agent can write you a really nice summary about logistics, but SAP actually routes the truck.
Right, and it does it without hallucinating fake inventory. The tech is actually highly impressive. It is just the macro environment and the rapid death of their legacy on-premise licenses that makes the total picture complicated.
Fair enough. So the big watch item for next quarter is really just seeing if those delayed deals finally close. And I suppose keeping an eye out to see if Reltio is a one-off fix or the start of a buying spree.
Yep. If they announce another sudden acquisition by July, we will know the organic growth engine is actually sputtering. Until then, they're basically just paying for time.
Well, buying time after a 28% stock drop is certainly one way to run a tech giant. Let's leave it right there before we uncover any more of those footnotes. If you want these earnings teardowns to just show up in your feed automatically, you can always hit follow on your player. It is honestly a pretty fun experiment building this, especially since we actually use AI to help turn hundreds of pages of raw financial filings into this exact conversation. We would really love your feedback, so if there is a specific ticker you want us to pull apart next, just email us at earningsunscripted@datamadness.ca or tap the X link in the show notes. Thanks for hanging out.
See you next time.